Here's to Eddie Van Halen, baby.
Go, Eddie. We lost a great one. Thank you.
All right. Today, my friend, we're going to talk about a topic that is near and dear to your heart and to my heart. And what was the title again that you had? I loved the way you said that. That was awesome.
I know you're always going to say that I'm too geeky, but I said risk management in times of uncertainty. That's what I just blurred. Does that make no sense? Maybe not.
No, it's awesome. I think I used more of a British accent though. Risk management under time of uncertainty. But yeah, so what I mean in English, it's like, how do we protect our capital?
It is.
You know, it's funny. I was there was a book I read, Trader Vic, Victor Sprandio, a book. I can't remember the name of the book right now, but he was is a great trader, still alive today. I think he's living in Florida now. And one of the things he said was that what I want to do is I want to protect capital and hit home runs. And I thought that was a great way of thinking of things. And you know, one of the interesting thing was, and I've always just kind of idolized him because he's I learned so much from reading and studying him. I was actually lucky enough, I did a video about my experience. I called it kind of the round trip investor, where it was for Real Vision. I did an interview in New York where I was talking about the experience of going from fundamental to technical and back to fundamental and kind of making a round trip in that. And now we just kind of use both. And he actually sent me a message saying that was one of the best interviews that he's seen on Real Vision. And I was like really flattered. I thought, man, that's like, I have achieved nirvana.
Yeah, it's like having Eddie Van Halen telling you pretty good riff, Louis.
Yeah, I was like, well, that was cool. You know, that was it. But so, I mean, how do you want to start this off, JP? Why don't you tell me what's on your mind?
Well, you know, I think the elephant in the room or the donkey in the room, however you want to look at it, is of course the election, right? So that's the overhead right now in the market, and I think there's a lot of uncertainty when you talk about uncertainty related to it, right? So maybe I thought maybe look at overall, maybe historical results around the election, and maybe from there we can dive into more practical things. What can we do about it, right? So one thing that I always say is that what the market does not like is uncertainty. It's not risk. I mean, risk is actually something that we deal with every day. There is no riskless investment. And risk we can price. And what that means is that as investors, we can decide to take on risk, right? This is the risk that we expect to get rewarded for taking, right? So that's very important to say, okay, there are risks that are intentional. So, okay, I decide to be in stocks. Stocks are risky, right? It's not like a government bond. And by taking that risk, I expect in return some additional returns, right? I get, you know, for us, the way we get rewarded is excess returns for that risk, okay? What we don't like is risk that we cannot quantify and we cannot put a price on it, right? So that's called uncertainty. Or, of course, now you see it everywhere. It's the unknown, right? To quote former VP. So
Rumsfeld.
What we need, yeah, exactly, Rumsfeld. Sorry, Secretary of State. So he was
actually quoting somebody else too.
Well, exactly. So it's been thrown around like every quote is get misattributed anyways. So what I mean by that is, so right now there is a lot of that. And the beauty of it, if you look historically, after the election, the markets tend to do better, right? And it's actually regardless of really, there's a lot of condition, right? Whether you have a continuation of the existing leadership, whether you have a flip of the leadership, or whether you go into a divided government. Now, if you look at this, the nice folks at Lord Abbott ran some statistic historically. They actually found that the market in general, the best outcome historically, again, those are just statistics based on 50 or so data points, is really when you have a divided government, which is interesting. And what's interesting about that is not that the market likes a stalemate, but it basically goes back to good old-fashioned compromise, right? So you basically end up in a situation where you actually may have discussions and you may come up with policies that have somewhat of a compromise in it, and that may be more constructive.
There's compromise, and there's also less movement of parts. There's less dramatic tax changes. There's less dramatic change in general. So markets can kind of price it in. That goes back to your point about uncertainty.
Exactly. And that's basically what we're seeing right now, right? So I'll throw it back at you. So we're seeing right now is even like this week, polls, we knew we were going to start seeing the market react more tightly with polls and what is the likely outcome. And as we are now getting closer, and I think the ability to put again, I'm going to use the word price into the outcome, right? So, okay, if this one is more likely, then I've got a 50-50, more than a coin toss chance of one side versus the other, then that means some things, right? So that's kind of where maybe the backdrop of that. Now that I said that, the question is, okay, what do you do about this? Do you just sit this one out and you just did a recording on that, and I'll let you summarize those comments, or maybe there are other ways of dealing with it? What do you think today?
Yeah, I think that making a strategy based on election news is really not a good idea, just in general. Because most of the time, one time I was talking to a pilot client of ours who is a really smart decision maker. And one of the things we were talking about retirement planning for him, and he's ready to retire. And he said, if I did this action, would it hurt me now? Potentially. Or can I benefit in the future? So I think that was a great question, because the idea is that you can make decisions right now based on what you think is going to happen in an election that could hurt you now. And then you may be wrong when it's a different outcome. So I think the only actions that should be taken regarding the election are things that potentially could help you if you have a certain outcome, but does not hurt you now. In other words, it's all upside. Mm-hmm. So, and I think that can happen. I'll just give you one example, hypothetical. I'm not saying this is something that I believe is going to happen, but if Biden wins and if there's some tax changes, there's some things that some people should do right now. They should move some expenses forward. They should possibly do some other things with regard to dividends, et cetera. So, but if that's going to hurt you right now and you're wrong and Trump wins, or if Biden does win and then he doesn't actually get those, how many things have these politicians say they're going to do that they actually do? Mm-hmm. I mean, so there's so much risk in making a strategy based on that. I'm not a big believer in that. I think the only things you should do are things that that are not going to hurt you, that could benefit you if you're right on your assumption about what could happen. Now, the other point I was going to make was that one of the things that we're doing proactively is I basically sent out an email with a quick video to all of our clients saying, we're going to do something a little bit different. Normally we do our annual reviews after the end of the year. We're going to move it up till after the election, because that's what we're going to assess. We're going to assess, are there any things that we can do that potentially could help us, but doesn't hurt us? Mm-hmm. It's like an option, basically. So anyway, I have a lot more to say about it, but I'll switch it back to you because I've talked enough.
No, it's very good, and I'm glad you took the client approach. So there is, of course, those things that would be affecting people's lives, right? Taxes and things like healthcare and all that. Of course, that is very near and dear, very critical to your success, right? So there is a direct impact of the outcome. If I take the more investment take on this, there are some sectors of the economy that become a little more uncertain, right? For example, I mean, I'm looking right now at energy. Of course, energy is an example of a sector that could be affected by the outcome of the election, right? Whether there's more regulation or the likes. But you're talking about, I'm looking at it now, and like energy, like how much more bad news can be priced into this sector right now, and it does appear that it's all been already baked in the cake. So if I look at the sector, it's hard to think about a much worse situation right now, and you see it by the volatility of the sector is actually going down right now as opposed to going up. So which is interesting. So maybe you think about a sector where all the bad news is in. The question is, what do you want to do about this? Do you want to stay away from it, or you want to take, get in, hoping that there's only good news left when all the bad news is in? So you can follow these specifically. Yeah. No, go ahead.
I want you to finish your thought, but can I just interject? So, from my view on what you just said about the healthcare, I think it's the same concept. What can I do right now that could help us if I'm right about it, but also won't hurt us? And it's probably going to happen anyway. And the two things that I see would be solar, and then the other would be biotech. So to me, those are the two areas that it doesn't matter. Like, you can get a huge tailwind if we have a blue wave, or if we basically, but you could also, it's probably going to be a good place anyway. The problem is there's a lot of uncertainty in terms of which player is going to be the right one. So you have to do it, deal with it a little bit differently.
Yeah, you basically, so you stole my line, but that's basically exactly where I was going. Right? No, that's no, it's a good thing. It means there is somewhat of a common thinking here. So exactly. So if you look at the energy stock, then you look at the whole, that's a whole entire sector, right? And you're like, okay, maybe the oil and gas drillers, maybe there's a lot of risk around them, right? So maybe you don't want to be upstream that way. But then, like you said, maybe if there's a more, environmental friendly government in place, then that gives some tailwind to renewables and solar. So then you position your portfolio for that, to take advantage of that. Now, there are some things, we talked about this last week, I believe, is there are some trends that transcend those events. And like we said, we don't want to trade around this this discrete event, which is an election. Some things are really independent of that. There's macro trends. I mean, definitely, energy, to go back to this, we are eventually going to favor alternatives to oil and gas, and there are some good things happening there. So you can choose to be in that on that end of things and be well positioned. Yeah. So yeah, so you kind of follow your thinking. Of course, we have to make a conscious decision of what those scenarios are, right? I mean, this is our job as asset manager. We of course have to have a shared view. Louis and I, we hopefully have a backdrop for the way we run money. As to, I don't think like I'm like the bear. I think things are going to pot, and then Louis thinks is a bull. Then that wouldn't work as far as thinking, right? So we have to reconcile those two into a kind of a common backdrop, and then from there we can build an investment strategy that positions ourselves according to that. But again, I think generally what's interesting about it is we try not to, overly place bets on a particular outcome right now. That's, I think, the takeaway.
Yeah, interesting. So as far as the risk management part goes, we actually flipped into opportunities. And I think that's part of the equation. In fact, yesterday we were having a discussion, when we were talking about offline, how our structure and how we run the money, we have this signal strength, or the amount of opportunity score, if you will, of each investment. And the degree to which you will allow an investment to be overweighted or underweighted based on that opportunity is something in question. And what I've noticed from our proprietary trading is that it's indicating that we should have more emphasis on the signal strength, the opportunity score, because because risk tolerance is time variant, which is a famous saying from JP, and that's very true. And therefore, your signal strength should actually change your volatility, because and some other studies I've been looking at show that volatility targeting is not it actually changes the distribution of the investment, that they may give it a better Sharpe ratio, but your actual results are worse. You need to have some more pumping, and Robert Carver did some great work on that in his last blog post, actually, which was fitting into what I've been noticing with trading the prop account. I mean, like today, CRISPR's up 12%. Today. Some of the themes that the prop account has been taking advantage of is more based on signal strength. And so I think that's one of the things that I think we need to, when it comes, and that also relates to risk, is what I'm getting to, is that if you allow that signal strength to recede and lower the volatility of the portfolio as it recedes, that is also a form of risk management.
Yeah, no, I think that's what it is. It's that, that idea of balancing risk management with opportunity exposure, right? So you have to we have to scale into to ideas. So and that's something that, when it comes down to it, I guess risk management is in our framework is really a security level decision. Yes, we may decide to take a portfolio level overarching. Exactly, mostly is. But it's mostly we let individual securities define their own risk characteristics and opportunities, right?
And that's really, really, really important, because the actual individual securities tend to lead, especially if you're dealing with the leading stocks. They tend to lead the overall market. You'll start seeing them breaking the new highs before the market breaks into new highs. You'll start seeing the leaders fall and break support levels ahead of the market. So it's really important to look at that. In fact, it's a better market timing indication by looking at the individual leadership than it is to actually look at the overall market, because that's just this average that's slushing around. And I think we get an edge, actually, because of that.
Yeah, no, I couldn't agree more. And I think in itself, it takes care of risk, right? We talked about, you mentioned a word that, gets thrown around sometimes, black swan, yesterday when we were talking. You said, okay, you can try to size an opportunity based on the worst case scenario, which would be kind of a black swan, a extreme adverse event, right? Mm-hmm. And usually what happens with that is you overcompensate for risk, right? Because risk is not normally distributed. So we have more large adverse events. So you do have to be conscious of that.
If you do that at the overall portfolio level, yes.
Yeah.
So it's a different impact versus an individual security level that has a lot of idiosyncratic risk, like in the stock market. I think there it has more meaning, but if you that more helpfulness in terms of maximum position size. But if you do it at the overall portfolio level, then you're going to wind up running too low a vol all the time.
Yeah, exactly. Yeah, so that's what I meant. So you you got to look at it, but then if you do that, also you end up. So we talked about the opportunity size, right? You have to maintain an attractive reward to risk ratio in what's in your portfolio, right? In this case, in the case of a long only equity portfolio like we run, you want to make sure that your upside capture really is not truncated because of your risk management. And that's what, like you mentioned, so that's the problem that could occur when you risk neutralize, right? So you could be you could be underperforming, maybe on a risk-adjusted basis, you look better, but then you want to maintain the return, right? So that's the opportunity, and the only way to do that is to increase exposure to your your
signal
winner,
strength.
to what's working.
So yeah, so if you're vol targeting, you know, your vol will be close to the target, but your upside, asymmetric upside, will be lowered. So the idea is in order to get more of that asymmetric upside, that signal strength has to push a position higher than what you would normally have on an equal risk adjusted basis. So, for example, if NVIDIA has a strong signal strength, which it has had over time, it should definitely have a higher risk budget than the average. Even if everything is in bull mode, it should be in a higher risk budget. I'm not saying that's the case now, because it's not the case now necessarily, but it was in that case not too long ago. So I think that's the point, that discussion that I brought up with you, and that's something that I think that we're going to make some tweaks and improvements on that for sure. But getting back to risk management, just, you know, pure risk management, I was wondering if you could talk through, and I've talked through this before, and I thought I want to hear you talk through it because it might have a little bit different angle. The different types of risk management selling techniques, like, for example, initial risk versus protecting the line versus letting something trail and run.
Yeah. So that's more tactical, right? But in risk management, and something that we may have mentioned before, how you trade an opportunity, a stock, right, has a lot to do, actually has everything to do with your time frame. Okay, so let's start with that. This is sometimes something that people maybe don't fully understand. And I remember it was a light bulb moment in my career when you realize that. So there's no bad trading strategy. There's just people who trade on the wrong time frames for themselves, right?
That's true. The biggest, I'll tell you, the biggest one of that is the value player who uses stops that are shorter term time horizons.
That's correct.
Those are the guys that get smoked because they keep buying these value stocks, and a value metric is a 2-year proposition.
That's a perfect example, right? So if you are a value person and all you care about is finding that cheap stock and without any maybe concern for other things, you should be willing to be in for some pain, maybe greater pain than maybe we're comfortable with, right? But that means that on a 2-year horizon, things can happen, right? So this is a pretty wide risk, right? Range of possible outcome that things can happen between point A and point B. So we manage, we manage to a much shorter time frame. That doesn't necessarily make us day traders. That basically means that our risk parameters are defined for our risk appetite. You know, that's something that we believe is a level of risk that we and our clients can stomach. And that's basically, like you said, the first step in the defining an investment strategy is to determine your objectives, right? And they can be whatever they are. For us, risk management was critical to that piece. So we basically have a target volatility that is lower than the market. Okay, that said, once you enter a trade, well, first and foremost, we believe there is a timing aspect. I know timing is kind of a four-letter word in some circles, but there is a timing aspect that you can, again, stack the deck. We mentioned that we can stack the deck in our favor by looking at some conditions that said, okay, this is a better setup than maybe a random entry. Let's make it that simple, right? And then from there, you look at what I call the life cycle of a holding, right? So you get in, so that's an initial position, and then you're like, okay, so do you have a backstop? Like, what is the worst outcome, right? Said, okay, things don't work out, it goes, and you reach your risk tolerance, I guess, on an individual trade. And for us, as we mentioned, this is the only thing you can predetermine, really. When you buy a stock, you don't know if it's going to double, triple, or go down, but you can determine how much you're willing to bet on that roll of dice, right? And that is very important. And some people don't understand that. And I think if you have to take one thing away, is that, like, just you can predetermine how much money you're willing to lose on every trade.
Yeah, exactly. So in this book, shameless plug, that I wrote, Financial Freedom Blueprint, you can get a free copy of it. I'll put it in the show notes. There's a chapter, Practical Advice on Managing Risk. And in that, it talks about where you start from. So, where do you start from? What is your comfort zone? There's 3 different things to look at with risk, right? Capacity, requirements, capacity. And then basically from there, then you figure out what's my maximum drawdown that I'm willing to accept as an investor. And then you can back into all these things. Mm-hmm. And we design our portfolios to have various types of risk profiles, because basically there's about 5 risk profiles that we've found over the years that generally apply. You can have a zillion. I mean, there's some back end technology that we've seen and that we even use that has like 11 or 12 risk profiles. But honestly, if you have that much of a risk profile definition, then you have no tactical ability, right? Because you're going to be so tight. It's basically strategic asset allocation. There's no risk management outside of diversification. So in order for us to actually have risk management with diversification as well as a tactical element, really, actually, ideally, it should be 3 risk profiles. But because of the way of the realities of psychology, we broke them down into 5, and that works very well in real life. And most people will be comfortable in those 5, one of those 5. So sometimes people need to be on the lower end. Sometimes people need to be on the higher end of one. But the reason why I'm bringing this up is because this is really what keeps people out of danger. Mm-hmm. I mean, that's the number one thing we always talk about. The biggest reason why people fail in investing has to do with their risk profile is mismatched with how they're investing. And people, because risk tolerance is time variant, you have to have some movement there, but there are some barriers that you can break from the comfort zone range, if you will. But anyhow, just thought I'd do that shameless plug.
Yeah. No. So that's, that's a basic framework. However you do this, and I'm glad you brought it back to the overall asset allocation, because I think people should not go from one extreme to the other. So
they all fit together.
Yeah, too granular is not productive, and so is too flexible. So we have to agree on a range of acceptable that. So
it all builds. It's all related. You have this overall objective, but then everything's got to be brought down to. It's just like setting a goal. You might have a 3-year goal, whatever it may be, but if you don't bring it down to bite size for this week or for today, then you can't really do anything.
Yeah. So I don't know. You asked me to maybe go into the other types of risk management. So I was going through what I call the trading, the life cycle of a holding. So you get into something, and I guess the worst thing that could happen is it goes against you right away, and you lose your capital at risk that you were winning. Yeah. Exactly. So, and then you move on. And that's always the idea, right? You want to be able to live to fight another battle, right? So
one caveat: you can always get back in too.
You can always get back. But exactly that. Yeah, we don't. Doesn't mean that it's a bad stock. It just means that it was not a right time to own that stock. So we might get back in. And there's a lot of those right now that we exited. I'm like, oh, those look great. They're resetting up. So I shouldn't have any qualm about. Getting back in there. Viva was an example of that. So so anyway, so once you own something, right, then it becomes, there's an additional level of risk, which the market doesn't care about, right? The market doesn't care what you bought it at. So that's the one thing that you should also be aware of, is the market does not care at all what you and I or anybody at home bought a stock at. Okay, it doesn't owe you anything. So, but we, because it's in our portfolio, have to now manage the open risk. So the amount of risk that comes with the profit, right? So then you have a decision to make about managing this profit, right? Do you want to protect what we call protect the line? At what point do you say, okay, I'm no longer willing to take this full stop loss, my full risk. Now I'm like in profit, and I would like to keep that profit or some of it, right? So you can come up with a devise some strategy to try to protect that, which is something we do.
And we should credit William O'Neill, who talks about that. Others who have been taught by him. It's amazing. The more you study some of the older time greats, the more you realize they knew what they were talking about. It's just like when you have a kid who's a young kid that are telling you don't know what you're talking about. Then they grow up and they go, Mom, or Dad, you were right. That's what I'm finding a lot with some of the things that I've heard from some of the old time traders, like William O'Neill, and you can actually quantitatively see why that made sense or why that makes sense. Younger people that have taken that on would be like Mark Minervini, David Ryan. That whole concept, we didn't invent it. It's just something that we've adopted.
Yeah. And it was funny last year. One of my student groups in one of the quantitative class that I teach decided to look at CanSlim, and I'm like, oh wow, that's pretty cool. You guys still I was very happy to see that those old time tested strategies still made their way to today's youth, up and coming asset managers. So that was a good thing to see. So working, marching down. So we like, okay, there's a profit protection, which has other moving parts to it. The question is it profit taking, right? So do you have, and this is something that is very, I would say, polarizing, right? Some people, let's say maybe a value type of manager that you mentioned, buys a stock and said, this is what it's worth. I've run all of my DCF and I've got a target and I think that's what it's worth and it's undervalued now and I'm going to wait until the market, gets it right and said, this is what it gets to. And when it's at that price, then you sell because you said, okay, it's reached my fair value and thank you. And I'm going to go somewhere else. And that's perfectly fine, right? Again, there's many ways of being successful. An alternative view to that would be to say, well, we're going to take some profit. So we have a target, a profit target, but we're going to take some off, but we're going to now play with the house money, right? That's actually a pretty good gambling strategy to say you're gonna keep your money roll on the table if you're on a hot streak. So you might actually maintain exposure to that stock to ride it into, however the market decides to keep bidding this price up, right? But you've taken some profit, and that money now, because that opportunity potentially has less opportunity, then you can actually reallocate some of those capitals into newer, fresher ideas. As you maintain the exposures to things that are working, right? So that's something that maybe some people, choose not to do, and it causes you. We talked about this risk reward trade-off. It actually truncates your upside, right? When you do that, your wins over loss ratio is going to be to not be as good as if you take a full advantage of
your
things.
Percent win will go up, but your hit rate will go up, but your average win loss ratio will go down.
The ratio will go down. Yes.
Yeah. So, but what's interesting about that whole thing about letting your profits run is you think about the very, very best stocks. Most of your returns come from a small group of stocks. It's not all of your stocks. And I think most investors want to have this feeling like they're taking a test. When you were in college, it's like I made a 90% on that test, so I was 90% right. And that's really not what you need to do in investing, because it's more of the Pareto principle where 20% of your stocks will make up 80 or even more percent of your returns. And that's really the key, because we can point to some stocks that we have right now that are their outsized gains are 3, 4, 5, 6, 7 times the average. And so it's a mathematical thing. But anyway, I think that's a pretty good coverage of that part of it. But I think we've covered, risk management. Is there anything else? We're coming up on time now. So is there anything else you want to talk about in terms of, kind of where we are right now? Something that people can grab a hold of and sink their teeth into right now?
Well,
anything at all?
I think it's been almost beaten to death, but don't get out, please. If anything, just don't. try not to say, I'm going to sit this one out. That is something that probably can hurt yourself more than any other decision, right? It's been proven over and over again. I won't state the research on that today. So you want to maintain exposure, make sure
As long
that
as you have a good process, you shouldn't get out. As long as you have a good
exactly. Yeah. So be in something, in an investment strategy that meets your investment objectives, of course, but your attitude towards risk. Like, you shouldn't feel stress. Your stomach should not be in knots. So you should feel comfortable with the level of risk that you have, and then hopefully stay the course. And hopefully, somebody is doing the day-to-day risk management and applying some of those techniques we outlined today, to further manage risk in these times of uncertainty and high volatility, right? So that's maybe my 2 cents here.
Excellent. So I just I'm just now putting in the notes a link that anybody can go to if they want to get a free copy of that book. Also, if you've been watching, go to retireready.live, and you can also get a report that I wrote on the 10 most common avoidable surprises. When people invest for retirement, they have these surprises and they're completely avoidable. And so that's a really helpful guide to kind of be aware of them, and then have some tips on how to avoid these. So, all right, JP, very good. I'm glad that we had a call today, and I'm going to go plug in my electric guitar, and I'm going to set up the camera up there in the studio and play a little Van Halen.
Can't wait to hear it. Thank you very much, Lou.